Japan was supposed to crash Bitcoin. It didn't. Everyone said this would be the end. Japan, the most disciplined economy, the strictest financial system, the country that once destroyed Mt. Gox. When Japan started tightening crypto rules again, people said, Bitcoin is finished. Asia will dump. Global crash is coming. But something unexpected happened. Bitcoin didn't crash. It didn't panic. It didn't collapse. Instead, it stayed stable. Then it moved forward. So today we ask a serious question. Why did Japan fail to crash Bitcoin? And what does that tell us about the future of crypto? Stay with me because this story changes how you see Bitcoin forever. To understand this, you first need to understand Japan's importance. Japan is not a random country in crypto. It was one of the first nations to legally recognize Bitcoin. It was one of the earliest adopters. It was home to Mt. Gox, which once handled over 70% of all Bitcoin transactions worldwide. When Japan makes a move, markets usually react. So when Japanese regulators began tightening crypto rules again, stronger licensing requirements, higher compliance standards, stricter exchange controls, traders expected fear, institutions expected panic, retail investors expected a major sell-off. Historically, this is exactly how markets behave. But Bitcoin didn't follow history this time. The crash narrative actually made sense. Here's why people expected Bitcoin to fall. Japan heavily influences Asian markets. Asian markets influence global liquidity. Regulation usually reduces trading volume. Lower volume often leads to falling prices. This formula worked many times before. China banned crypto. The market crashed. India threatened bans. Prices dropped. U.S. regulation rumors, massive volatility. So when Japan tightened rules, analysts said this would trigger a domino effect. But the dominoes didn't fall. They stayed standing. So why didn't Bitcoin crash? Because Bitcoin has changed. Bitcoin in 2025 is not Bitcoin in 2017. Back then, the market was mostly retail money. Trading was emotional. Weak hands dominated. Exchanges were centralized and fragile. Today, the market looks very different. Institutional money is involved. Bitcoin ETFs exist. Long-term holders control supply. Cold storage is widespread. Even governments are watching closely. Japan didn't crash Bitcoin because Japan no longer controls Bitcoin. No single country does. Bitcoin has crossed a critical line from a speculative asset to a global monetary network. And once an asset reaches that stage, regulation doesn't destroy it. It tests it. So where did the selling pressure go? Because surely some people sold. The answer is simple. The selling pressure was absorbed. ETFs absorbed it. Institutions absorbed it. Long-term believers absorbed it. Every time weak hands sold, stronger hands stepped in. This is a classic market signal. Distribution turning into accumulation. Markets don't crash just because sellers exist. They crash when buyers disappear. And buyers did not disappear. They increased. Most people misunderstand regulation. Regulation does not automatically mean destruction. It means structure. Japan was not trying to kill Bitcoin. Japan was trying to reduce risk, protect consumers, and control fraud. Smart money understands this. Regulation removes scams. It increases trust. It invites institutional capital. It builds long-term stability. Bitcoin crashing after regulation is an old story. Bitcoin surviving regulation is the new one. Another major reason Japan failed to crash Bitcoin is because global power has shifted. Crypto liquidity is no longer centered in Asia. Today it is global. U.S. spot Bitcoin ETFs bring massive demand. Middle Eastern sovereign funds are watching closely. European institutions are entering quietly. Latin America continues real-world adoption. Bitcoin no longer depends on one country or one region. It flows around resistance like water. Block one path, it finds another. That is decentralization working in real life. This event confirmed something very important. Bitcoin is anti-fragile. Pressure does not weaken it. Pressure strengthens it. If Japan could not crash Bitcoin, then ask yourself, Can any single country stop it? Can any single regulation kill it? Can fear-based narratives still control it? The answer is becoming clear. Bitcoin is no longer asking permission. The most important signal wasn't the price, it was behavior. There was no panic, no mass exits, no fear-driven collapse. The market stayed calm. That calmness shows maturity, it shows confidence. This is something early-stage assets don't have. Bitcoin now does. Japan was supposed to crash Bitcoin. It didn't. Not because Japan failed, but because Bitcoin evolved. This wasn't a hype-driven pump. It wasn't blind optimism. It was proof of resilience. And markets never forget resilience. If you understood this moment, you are ahead of most people. Because the future of Bitcoin will not be decided by fear. It will be decided by survival. If this video helped you see Bitcoin differently, like the video, if you want clear, honest crypto analysis without hype or fear, subscribe. And share this video with someone who still believes one country can kill Bitcoin. History just proved otherwise. For real Bitcoin updates and global market news, subscribe to DS Global Forex. No hype, just facts, analysis, and what actually matters. See you in the next update.